First thing I want us to look at is a curiosity with real household consumption this side of the Second World War. I first came across this graph almost 20 years ago. And it did impress me because the positive economist in me, okay, now I'm sort of jumping away from being a philosopher and now I'm looking at graphs and all the stuff that economists kind of lap up. And I looked at that graph and I thought, if nothing else, this is a fabulously interesting graph about society. Why is it fabulously interesting? It's because it's got a kink in it. Somehow, real household consumption plodded along at more or less the same level, year in, year out, for about half a century. And then all of a sudden, something changed and it started moving in a different direction. And you start asking yourself, what caused it? And answering that question proved to be a little bit difficult. You can ask questions, you can say, well, maybe it was technology. Certainly the Second World War has a reputation for introducing an awful lot of technology. Before the Second World War, there were lots of factories that were still using steam engines, and there were lots of deliveries made using Clydesdale horses to drag carts. After the Second World War, people were using motor cars and internal combustion engines, electric motors, and so the industrial world kind of changed quite radically. So yeah, it could be technological. But that would account for a step in real household consumption. It would not account for a change in direction that continued year in, year out, especially when you look at the first part of the 20th century, where there was also considerable technological development. There was a fair bit of technological development around the First World War. When you think about it, the aeroplane was invented early in the century, but it doesn't seem to have had very much of an impact on real household consumption. There were many other technological developments that were happening around that time, and there's such a long list of them. The introduction of electricity, the development of efficient public transport, sanitation, availability of energy. Lots of things were happening in the first half of the 20th century that didn't cause real household consumption to increase. Okay? So we did have technological development in the first half of the century. We had technological development in the second half of the century. Why the change and why not a step? It's a puzzle. And that continues to be a puzzle. Okay, so we're just going to come back to that, and eventually, hopefully, I'll be able to explain why that change in gradient occurred and what it can tell us for the future. Another graph, which is a bit of a puzzle. This is a graph published by two researchers, Alison and Sean, which tracks house prices and incomes against average earnings over a period from about late 80s for a period of about 20 years. Okay. And what you see is that average earnings were fairly modest. House prices continually outperformed them. Now, if this graph had started a bit earlier, it probably would have been a bit more interesting, and later on I'll show you one that does exactly that. But there is something mysterious that's happening, and this should be exciting for a property person. House prices consistently outperform growth in either the CPI or average earnings. This is one of the reasons why everyone thinks that investing in real estate is such an extraordinarily good idea. And the sooner we can all have an investment property, the better. And largely we live at a part of history where everybody is out trying to be a property investor. I would suggest to you that everybody can't be a property investor. After all, let's imagine this is all of the population of Australia got in the room, okay? And I have an investment property. It means that one of you will not be living in the house that they own. And if half of us are property investors, the other half will not own their own home. And so in a sense, you can never have more than half the population being property investors. And if I own 2 houses or 5 houses or 10 houses, that means I basically put 2 or 5 or 10 of you guys out of even owning your own house. So you're going to be paying rent all the time, right? You simply can't have a population full of property investors. So it's not as though everybody can get onto the bandwagon. But we have gone into a period, unlike, say, the generation before 1970, where very few people were property investors. Okay, and most people would invest in other things, usually invest in businesses and shares and that sort of stuff. So there's something peculiar happening there. And we have got into this mentality that property investment, of its nature, per se, the way it exists, the metaphysical nature of the property is that, you know, investment is a good thing because it always outperforms wages. It certainly has been over this period. But I would say this period, if you think about what's behind the stuff, wages, rents, all that sort of stuff, and you apply what we've been learning in the earlier parts of this subject, you'll see that this cannot continue. Abelson and Chilton, and they've made a bit of a name for themselves around Australia for studying this sort of stuff. That's all good and interesting. Now, I'm going to labour the metaphor of selling the farm. I won't go through all of this in too much detail, but there are 2 things that can be going on. There are 2 possibilities for this rising household consumption. One is that we've got to a situation that for whatever reason, Australian economy and Australian labour situation is just better and better and better year by year by year. And if that's the role, well, there's nothing to worry about. It'll continue to go like that. However, it could be that we're going through a structural change. Maybe not a structural change or a social change, but a change which is going to be changing from one way of doing business to another, and it's actually going from one steady state up to another one, and there's going to be another steady state again. Right? And so the possibility is that we might be moving to a position through this increasing consumption that eventually there'll be another kink, another bend in the graph, and maybe somebody looking at household consumption over the 21st century, maybe in 100 years' time, will be looking at ABS statistics and say, there's an interesting kink here. It was growing like this, but then somewhere around 2010, 2020, whatever, it flattened out. And it's been flat for the last 80 years. People could be saying that in the year 2100. I don't know, but I think with a little bit of common sense and a little bit of, nous, we can actually get some clues as to what that might be happening. Okay, you've heard the expression selling the farm. If you've got a farmer who's got, let's say, a herd of 1,000 cows, and each year he produces 200 calves, he's basically able to run his farm by selling 200 cows each year and making an income. Makes sense? If he thinks to himself, I want more income, what he can do is sell maybe 300 cows. He can do that. And for a few years, he'll end up with a higher income. Let's do that. Sells 300 cows. Okay? Same farmer, same herd, same product. Okay? But now he's telling all of his mates, because why, you've got the new car and sort of you're living pretty comfortably, and so, well, I'm selling 300 cows a year. And they're thinking, well, I can only sell 200 cows a year, and I've got a farm just like yours. He lives pretty well for a while, doesn't he? What's happening? Okay. Farmer is very happy while he's able to do that, but what he's doing is selling off his stock. And eventually, reality is going to hit, a whole lot of numbers in there, and he returns eventually when sort of sobriety kind of catches up with him again, with somebody, maybe his son or something, working out that now the herd is down to, maybe only 500 cows, and so from then on and forever, he's only ever going to be able to live on half the income. Okay? So selling or earning, like living on stock by selling your capital resources feels good while you're doing it, but eventually leads to a permanent problem. And this is something we could be doing in Australia at present. It takes a while to do it. It's not something that's going to happen over a few years like our farmer. It could be something that could happen over a couple of generations. Okay. That's a conceptual framework that I'd like to apply here. I suggest that society underwent significant social change over the last 50 years, especially in the period between about 1960 and about 1980. We saw massive social change, not necessarily primarily in the economic area, but I think it put us onto a different trajectory where the way that we approached our economic puzzle, from the point of view of the household especially, changed things in a way which actually gave us a higher income and put us into a nicer place economically, where we were able for the first time for a long time to be able to afford those investment properties. I want to look now at some more graphs. This is the graph of home mortgage interest rates over a century or so. Now, often when we look at the interest rates which are common today, back around sort of 5-6%, people say, they're historically low. And to a certain extent, depending on your frame of reference, what history means to you, yes, if your history goes back to about 1970, maybe even 1980, today's interest rates are historically low. Because 5% is an awful lot lower than 13, 14, 15, 16%, which is where interest rates were at various times in living memory. And so, interest rates down here somewhere, compared right there, historically low. Compared though to longer history, interest rates are probably still historically high, except for that odd blip between about 1970 or so and about 1990. Two questions come from that. One is, what is the real historical average, or the norm, historically? And the other question is, how did it come about that we got this mountain of high interest rates happening between about 1970 and about 1990? Important question. Because understanding where those high interest rates come from is an important way of predicting whether they might happen again. Before we go too far with that, we can start to look at a couple of the theories we might have. One of the curious things is that you guys would have studied a bit of economics and you would have studied a bit of finance, I expect. One of the curious things about the finance theory world and the economics theory world is that they all have theories of interest rates. In economics, we're told that interest rates, using monetary theory, always tend to operate in the opposite direction to inflation. So if you've got high inflation rates, you deal with that by raising the interest rates, because if you've got high interest rates, that will cause inflation to be low. And so high interest equals low inflation. Low interest rates will cause people to go out and borrow like crazy, and so inflation will go through the roof. And so if one goes up, the other one will go down. However, if you open a financial management textbook, you'll find that there is a theory of interest rates, that financial managers use, which is known as the inflation premium theory of interest rates. The inflation premium theory of interest would say that the interest rate that you're going to get charged by the bank is worked out as some margin above inflation. So inflation goes up, then interest rate premium, or inflation premium theory, would say that if inflation has gone up by 2%, then probably interest rates will go up by 2%. So they go off in the same direction. So you've got these two different disciplines, both of which you guys have studied. I don't know if you've studied them into this particular question or not, doesn't matter. You can go off and do it in your own time. But two diametrically opposed theories of the relationship between inflation and interest. So let's now look at the inflation situation. Inflation has this graph. Now I've put this yellow patch over to kind of mask out part of the graph. If you look at the graph, or when you looked at the graph, I'll just see if I can get that to go back a bit, right? It just looks like it's all over the place, right? There's just numbers up and down and whatnot, spikes and troughs and whatnot. But by putting that on, what we're doing is putting a threshold in to say, let's look at high levels of inflation. It's very seldom that the inflation rate is so low that it actually goes negative. There have been occasions, you can see it on the graph. Usually they're very short-lived spikes of absolutely negative price escalation. Most of the time, they're very, very slight reactions to excessive inflation in the recent history. But inflation you'd expect to always be positive in some way, either naught or some positive number. Absolute deflation is a very rare occurrence. We can tolerate modest inflation up to about the level of the economic growth rate. If we've got economic growth of 3%, then we can have inflation of 3% and everything's happy. John Maynard Keynes drew that out in a great deal of detail, and it actually, well, anyway, I won't go into that, it's a bit of economics. But what I want us to look at is the periods of high inflation, those places where inflation was, just a bit over the top. Okay, and how do we look at that over the last century or so? We don't have to worry about inflation over the last 20 years or so, because generally it's been below this number. So this, I've put in 5%, let's say 6% as nasty inflation. 3% we can cope with, 4% is not too bad, 5% would be uncomfortable, 6% that's a real threshold towards bad news, right? So when has inflation been seriously bad news? And we can separate that into three periods. There's an inflationary period around the First World War, especially after the First World War, there's an inflationary period. But if you look at that period, in the first, between 1910 and 1920-ish, those periods of high inflation were very short-lived, just a little spike here and there, and it went away. And especially if you look at the first one, we see that was, this slightly fatter one here was actually followed by a serious deflation, which is saying that all this was unsupported, so it came back down. This was about 1920, beginning of the Roaring '20s, so it wasn't a bad time economically. If we go to the second patch, it happened after the Second World War, and so it came in a bit after 1945. It was a period of post-war reconstruction, it was a period of technological development, so a lot of good things happening there, and you end up with this period of sustained inflation. Now, sustained here is curious because it's sustained compared to any time previously, and if we were to take this back into the 19th century, we would find the same kind of pattern. Okay? But this is pretty awesome length of inflation. It's sort of almost 10 years of inflation, up 6%, and that was kind of legendary. Whoa, what's going on here? And you say, okay, yeah, the war's over, everyone's happy, we've got lots of technology happening, that's fantastic. But that went away in certainly the early 60s. Well, 1955, it's gone. 1960, it sort of disappeared. There was a bit of a recession here in the early 60s. But that was legendary. That was a really huge thing. Okay. Why am I stressing that? Because when you get to the next patch, you have a patch of inflation that started early 70s and wound on to about 1990. In fact, it started, it was 6% around 1970, and it carried on to about 1990. That's 20 full years of toxic inflation. Weird. Historically unique. Where did it come from? What supported it? Okay. So? There was no war, but really there was no war before the First World War as well.
Social change. But you have wars every 2 generations that are like sort of major.
We haven't? Yeah, it's interesting. There's a chat. If I had more time, I'd talk about Condrative, and you might want to sort that out. Okay, we'll talk about social change as we go along. Okay?
A lot of births
A lot of?
was there a big surge in consumption?
Because big surge of consumption from about 1950 onwards. But you see, you don't see that in the inflation graph, because this inflation problem sort of started fully, 10 years after the 1950s had finished. Right? Social change. Okay, well, the answer is up there with social change. But the curious thing is that it's a period of absolutely historic, long-term, toxic inflation. Now, inflation in macroeconomics is considered as a quasi-tax. It's basically a burden on society. It is a limit on society. You might sort of feel good because your property investment, your investment property, what have you, is kind of coming along in leaps and bounds, what have you. But for most people, what it means is if you've got savings in the bank and you want to go out and buy a new car, the new car's going to cost you more, and so the money in the bank isn't worth as much. So it's like you're losing a certain amount of your hard-earned earnings from way back. Okay? And in macroeconomics, as I say, inflation is considered as a tax. And how could you tax people for 20 years straight without the wheels falling off the economy? Okay, what's the explanation for all of this? Well, the other thing that before we go too far into this, is worth kind of giving some thought to, is that the economists are right to a certain extent when they say that generally high interest rates do discourage and damp the economy. We've seen that in the monetarist theory, which has been running our economy now for the last 20 years or so, actually 30 years. Okay. And so, you'll hear, and you guys are probably sort of onto this, that, if the inflation is a bit on the high side, what's the news in the financial and the Fin Review? The RBA is about to put up interest rates. Why are they going to put up interest rates? Because everyone knows you put up interest rates, inflation comes down. Okay. Now, the period that we're looking at here of legendary high toxic inflation is also the period of legendary high interest rates. Excellent. Yeah, no, that's a good point. Yeah, we went away from the Bretton Woods gold standard about this time. It's a little bit of a tricky one, that. While you'd expect the floating of the dollar to have an impact, it should be an impact that should have basically evaporated over about 5 years. It sort of changed the dynamics, but should have produced a bit of a blip, right? In fact, probably most of it would have been done within 2 years. So while you're 100% right, and that's a very insightful point, the gold standard is a really interesting study in itself, but it can't explain 20 years of toxic inflation. Okay? And especially 20 years of toxic inflation when the household, and I'm using the household as the unit of society, has got the tax of inflation plus the burden of record high interest rates. Why was it that the high interest rates during this period didn't drive down the inflation and put it back in its box? Both of them were able to roll along quite happily with each other. Now, if we take a step back and say, oh gee, that's a real strange puzzle, eh? What can we do? What I'm describing is two major economic burdens that were on the economic unit. Okay, and we're calling the economic unit the household. Normally, if the household is burdened by high interest rates, they'll pull their horns in and they'll stop consuming, therefore inflation will pull back, because the burden of taxation is causing people to make different decisions, and so it backs off the burden of inflation. And if the burden of interest rates, interest rates go down, then all of a sudden the household is relieved of that burden, that drain, and they're able to go off and spend stuff, and that causes the inflation. So usually you've got this seesaw effect. Okay? It didn't happen here. What was happening? If we think at the level of the household, what was going on through there was something quite radical, at least in the history of the West. And that is that the household had discovered a new form of economic resilience. It was very, very simple. If the household was starting to be a bit stressed because interest rates were getting a bit high, what's that? Yeah. In 1970, very few women were working, especially through their 20s and 30s. People would tend to leave school, get a job, they get married, then sort of retire, basically look after the family and so on. and most households were single income. If we look at female labour force participation, we get a graph looking pretty much like this. These are the labour force participation rates for particular age groups. They're the age groups that are picked for that prime of your life kind of period, through your 20s, 30s, 40s, where, especially 30s and 40s, where for a lot of households, a bit of time when people would be having children and bringing up families. In a single income household, basically the labour force participation, female labour force participation is lower there. If you look at other age groups, it's not so much of an issue. Women, say, over 45, their kids are all in high school and all the rest of it and go back to work, and so not much of a change there. But this is the place where the change really came in. What that meant was that when inflation started to get a bit nasty in the early 70s, it simply meant that the household was able to send an extra worker out into the workforce and basically increase the household earning capacity. And that was a nice thing. It meant that we didn't mind that inflation had gone up a bit. We're still going to buy the new car. Likewise, when interest rates went up, you look at the mortgage and say we're going to move into a smaller house or out of the country, or simply pull back when we're thinking about moving to a different house. You didn't have to, because again, it was just a matter of getting that second income sort of locked into maybe longer hours, or going from working a 3-day week to a 5-day week, that sort of thing. Those benefits that came in through increased labour force participation meant that they were, if you like, crystallised into property values. In 1960 or 1970, property values, in a sense, were linked to single income households. It's simply that the household couldn't afford to pay for a property that required 2 incomes to pay for it. If you're in a situation where you only had 1 income, you're simply out of the game. But starting at about 1970 and progressively coming in up to about 1990, you had this increased labour force participation, which meant that because the second income was becoming a permanent part of the landscape, when you go along to the banks were willing to lend more. When you went along to an auction, because you were bidding as part of a double income household, you were able to bid more. The single income households basically ended up sort of renting until they fell off the perch, or worked out the game and went into double income sort of framework. And so largely what we can see is that during this period, from about 1960-ish, rolling off around 1990, we had this monotonic increase in female labour force participation. It meant that the household was resilient. It was able to put up with high inflation rates, and it simply didn't stop its economic demand. It was able to tolerate high levels of interest rates, again, without slowing down. And so the economy was able to surge forward, still people buying their new SUVs and their new investment properties and all the rest of it. Because inflation and property values were going ahead so solidly and pretty much in a uniform direction, it taught the society that property investment was something that you did on the basis of capital gain, not on the basis of yield. Up until about 1960s, certainly 1970s, if you became a property investor, you invested on the basis of yield, because you weren't expecting huge capital gain. Through this period, let's say 1970 to 1980, we saw 10 years of sustained capital growth, and the capital growth continued even though interest rates went higher, and people were saying, look, whatever you do, the more you borrow, the more you make in property. And so what we need to do is structure ourselves so that we can buy as much property as we can, preferably property that we're not living in. We need to become property investors, because that's a far better way of ensuring our economic stability, because there's something magic going on. Capital gain in prices is something that's somehow now come to roost, and it's a permanent part of our world. Okay? And behind that, there's the enthusiasm to say, Well, if buying the investment property means simply having the double incomes for a little bit longer than we expected, maybe putting off the family for a little bit longer than expected, that's fine, because eventually we're going to end up so wealthy and wonderful that it's going to be all worthwhile. And that process went on, first of all, for a few years in the 70s, and then it continued on into the 80s. It basically taught Australians, especially living in capital cities, that investing in property was a very good thing to do. It always made money, regardless of all of the negative economic indicators. Interest rates went up, you simply ignored that and borrowed more. Property values went up, you ignored that and borrowed more, because it was an indicator that there was kind of an upside still happening. And when people got around to sort of telling their kids what to do, after 20 years of this happening, and it happened between about 1970 and about 1990, okay, 20 years into the game, you know, mum and dad are talking to young Johnny who's just finished school and sort of started work. And what do you tell young Johnny? Well, don't worry about working too hard, just make sure you get an investment property as soon as you can. And so there was this perception that investing for the purpose of capital gain is the way to go. That's largely why we have strangely, bizarrely low residential property yields. You know, 3-4% is not uncommon. And we don't worry about residential property yields going down to tiny levels. And we certainly have over the last, say, 5 years, and they're sort of coming back a little bit now, because we've got this mentality that our culture learned in the 70s and 80s of the last century, that it doesn't matter whether you've got lousy yields and you've got negative leveraging and all that sort of stuff, because you're going to make a lot more money eventually. Okay, that all worked historically. And it worked largely because of the rising female labour force participation. It's an interesting game, but one that not necessarily goes on forever. As we graph the labour force participation rates, here we've got male, female and total labour force participation rates over the period, well, up until recently. And we can see that through the 80s, unfortunately it'd be nice if this graph started probably 20 years earlier, because it would tell a far more interesting story. But you can see the trends here, that the female labour force participation was definitely growing during that period. Oddly enough, the male labour force participation from the 80s onwards has actually been falling, which is a little bit of a sad story. Is that right? Males falling, or at least sort of plateauing out. Females growing pretty aggressively, and persons overall having a modest growth. Okay. However, by the time we get to about the early 90s, largely we're starting to plateau from the point of view of total labour force participation. And even if we come further forward, we find that from about the year 2000, female labour force participation hasn't been growing all that much. Now, why is that important? It's because the driver from the 70s to the 90s, which gave us this investment mentality, invest for growth rather than yield, it's no longer working. Okay. And so the wisdom that is passed on parent to child during that period actually doesn't have fundamentals under it anymore. So we can't see any upside from labour force participation. Corresponding to labour force participation is trends in Australian birth rates, and we can see they have been falling, but they've largely sort of flattened out. To a certain extent, the household is a lot better off by not having children economically. What it means is that you don't have as many dependents, you don't have as much reason not to go to work, at least for the double incomes. We often talk about the baby boomers at present, and I probably get a little bit sensitive when people use that name, because I am one, and I'm about to die off, so you won't have to worry about me in another 20 years' time. But one way or another, we talk about baby boomers, don't we? Now, the interesting thing about the baby boomers is that they relate to people that were born between about the post-war period up until the early 60s usually. It's probably sort of stretching into the baby boomers. And it relates to this lump here of high levels of birth rates. Right? The interesting thing about the baby boom generation is that it actually wasn't a baby boom. If you look at the graph over the longer period, over the entire 20th century, and maybe sort of going back to the late 1800s, certainly back to about 1870 or what have you, what you find is that the baby boom wasn't an historic high level. It was actually a return to the level of fertility that previously had been common around 1920. So the baby boom wasn't a boom at all. It in fact was a recovery from a trough in the birth rate that had sort of bottomed out during the 1930s, which is one of those curiosities of history that we could talk about another time. However, what we're finding is that we now have a stable, low growth rate or birth rate, which is now stabilised at a level of fertility which is below the bottom level that we've ever seen in history before. It's a level of fertility which basically ensures that the long-term population trajectory for Australia is negative. That's going to be a little bit of a problem for the property market. And the reason for that is that if I'm building new stock and the population is falling, who am I going to sell it to? Because for every 10 people who retire, assuming the house doesn't fall down, we might only end up with 9.5 people coming in to buy. Not really good for growth. We do have people pouring into Sydney from other places, especially regional New South Wales, also from other parts of the world, and that's an issue in itself. But it becomes a little bit unstable, a little bit unsustainable, a little bit risky when we're not able to support demand in our property markets by homegrown people, especially over generations. And so that's kind of one of the issues which is kind of lurking in this graph. The other advantage of low birth rates is that there's this low household dependency ratio. What that means is that in a particular household size, by having a smaller number of dependents, one income will tend to be able to be spread further, because instead of supporting 5 people, I might be only supporting 3 people, something like that. So it also gives the household extra economic resilience. So there are these two factors. One is the double income, and the second is the reduced number of dependents, which means the reduced number of, basically useless mouths to feed, that sort of thing. Okay. We're going to look at some other graphs. We had a spike in the divorce rate back in about the mid-60s, so that's another factor which could be coming in here. We've really gone from one relatively stable level. Okay, there was a bit of a rise through the period from about 1930 to 1970, but it wasn't really that great compared to the spike across 1975. But now we're back to a fairly stable level of divorce. So it's really from one steady state to another steady state. So the selling the farm kind of concept kind of is lurking in there. But it's an interesting kind of factor, and it does have an impact on the demand. Basically, once you go from a low divorce rate to a high divorce rate culture, obviously you're going to multiply the number of houses that are required. In the pre-divorce world, you might have only had one house per household, per family. Now you've got 1.5 or 2, something like that. But it's a one-off kind of effect. Then we can look at things like household occupancy rates over that period. Household occupancy rates over the last century or so have been falling fairly gently, but constantly. Household occupancy, measured by the Australian Bureau of Statistics, is done on the basis of measuring how many people in each occupied dwelling. What that means is you cannot get a household occupancy rate less than 1, because empty buildings are not counted in the statistics. When you think about the human realities of small numbers of household size, you start to see some strange things. One is that generally it's understood that in order to have children, you've got to have 2 parents. that would mean that if you're going to have a household that's got children, you're going to have mum and dad and at least, one little bubby boy, right? So you're going to have a household occupancy of somewhere around 3. If they had 2 children, you've got a household occupancy of 4. So the number should be comfortably above 2. Okay. And comfortably means numbers like 3 or 4. What are the numbers at present? Over Australia, the number is down now around 2.5, 2.6, which means mum, dad and half a child. Not exactly sustainable over a longer period, because that half child will then in another generation or so become one of the parents, and that means that instead of you need something like 2 children in order to reproduce the two parents, right? So it's not going to work very well. There are some other really peculiar things. If we were to hop on a bicycle and go a reasonable bicycle distance from where we're sitting right now, there's over half a dozen suburbs where the average household occupancy rate is less than 2. Numbers like 1.8 common in places like Surrey Hills, Glebe, and a handful of other suburbs, not too far from where we are. What does that say? If you live in an area with a household occupancy rate of 1.8, it means that if you go home tonight and you've got someone to talk to, you're living in an above average household. Now, you can hardly have mum, dad and any kids if the average household doesn't even have another person to talk to. From a social point of view, human point of view, that's suicide, social. But as I say, many parts of Sydney are down around the 2 level, and again, within bicycle distance, let's say 20 minutes by bicycle, most of the suburbs you'll come across will have occupancy rates of less than 2. The way that we're moving to a different household character is also a bit of an issue. So the idea of sharing and so on. There are a lot of experiments that are kind of going on right now, which is very interesting. And I think it's something that's good for you guys to be actually tracking and taking interest in. In the short term, that actually provides greater demand for households and a greater capacity to pay rent and buy houses. Because if we've got 2 people, let's say, a couple of blokes kind of decide to go and sort of hang out together. Got 2 incomes, got no kids, was not married. We're able to pay rent and we don't really worry too much. The issue here, though, what happens in 20 years' time? Because if it's a whole lot of random people just filling up a house in order to be able to pay the rent, in 20 years' time, those people are going to be retiring and you won't going to be having very many people coming in to buy those houses. So the property market is going to be not looking good. Okay? So they're the kind of issues I'm wanting you to think about. This sort of social change impacting on the property markets. Okay? You're 100% right. Okay. Let's move back to the... actually, do we have things that happen to this graph? Rats. I was rather hoping that graph would have... Let's go back a little bit. Oh, now I've really mucked it up. Okay, we'll just go with this one. Okay, this graph is a lot more colourful. Okay, it is putting a lot more lines on the graph. It's looking at house prices over a longer period from about 1970 onwards, which is the beginning of when this was really interesting to look at. It also looks at adult earnings, in other words wages, and household incomes. And as well as that, it's got on it a couple of capital cities. It's got Australian house prices and Sydney house prices and so on, and the CPI, just a good measure. What we can see here is that generally there should be a parity between incomes and house prices to have what's called intergenerational equity. By and large, if we look at the question of intergenerational equity up until about 1970, we can find that buying a house for a household was about as difficult in 1910 as it was in 1930 as it was in 1950. There were little ups and downs with the availability of building materials and so on. But by and large, it was actually getting easier, with the exception that a few years after the Second World War, because of the lack of building materials, things went through a bit of a nasty time. But generally, it was kind of moving forwards. However, that intergenerational equity, that idea of the next generation finding it easier to get into a house of their own than the previous generation, actually sort of changed somewhere around 1980. Around then, we see that house prices started to outperform wages, and it sort of crossed over that point. Now we tend to be looking at household incomes rather than wages, because we've moved from one income to a double income. And house prices have outperformed now household incomes. That's the green line, which has been totally blitzed by the house prices. And there are a couple of other prices. There's the CPI and the BPI, the Building Price Index, in there as well. Now, what we're seeing there is a very strange phenomenon, and what it means is that the percentage of income, of economic wealth, which previously would go to consumption, which kind of basically keeps people employed, is now going straight into rent, which doesn't employ a great number of people. Land rents don't employ people. Okay? It simply goes into the pocket of the landlord. Whereas if you have people with more money in their pockets to be able to buy new cars, go to restaurants, buy new houses, not houses, but new clothes, better food, all that sort of stuff, that actually helps employment, which is an economic stimulus. We talked about that, I think, in about second or third class. So we've had this period of sustained trend in the wrong direction. Now, when we unpack this, we said, well, we can understand the movement, the unfortunate movement in this between about 1970 and 1990, because it's explained by labour force participation, particularly the double income family, and to a certain extent the reduction of dependence in households. But what explains what happened this side of about 1990? Because this side of 1990, there shouldn't have been the energy in the economy, in the household, to be able to support that sustained growth, which is still rocketing past the capacity of the household to pay for it. In other words, the household incomes. And you can say, well, there's demand and all that sort of stuff. I would like you to try and get your heads past the idea of supply and demand as the explanation for everything in economics. Right? That's really kind of gross and simplistic. What you have to do is think about what is it which is behind the demand factors. What is it that's behind causing the supply factors? Because it's really those things which are the interesting factors that you can actually sort of test and see and predict and look at where it's going. Okay? So you can say, yeah, okay, people need to live somewhere, so demand is strong. Well, it's kind of true in one sense, but you're not actually saying anything. Why was it that we were able to have house prices go through the roof this side of 1990? Anyone like to suggest? Some of you guys should know the answer to this one. This side of 1990. People in general. What's that? .com? Yeah, no, that was an issue, but it didn't really affect on that because most people weren't affected by the .com thing. Technology has kind of gently helped us all by increasing our labour efficiency. Okay. Now the answer is indebtedness. Okay. In 1990, if we were able to show all of these graphs at once, maybe if I had them different, sort of shown on these different screens around the room, we could see that interest rates collapsed around 1990. They went from historically low to back to the long-term, kind of, something a bit more sober. What that meant was that people who, for the previous 1970 and 1990, but for the previous 20 years, have been saying, borrow, 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 even if it hurts. Suddenly they're presented with interest rates going from double-digit numbers, 10, 12, 14, 16%, down to 6 or 8%. And they're thinking, wow, it's only 8% interest rates. Isn't this fantastic? We'll go out and borrow. Because we all know that the more you borrow, the more you make. And so people started borrowing. And what we saw is that from about 1990 onwards, household debt levels started to rise. This was first observed noted by the Reserve Bank of Australia around 2002, I think this graph comes from, or 2003, I think it was about the March 2003 RBA newsletter that this graph comes from. And there are more recent ones I could put up, and I really should have been lazy. When the RBA looked at this, again, around 2003, they looked at household debt levels. And the ratio, the statistic they used, was the ratio of household debt over or divided by household incomes. And so you went up with the percentage. Up until about 1990, household debt levels, total household debt levels, were about 50%. It meant that if you had a household that had an income of, let's say, $100,000 a year, then it means that that household tended to be in debt to the tune of about $50,000. Okay? About half your average earnings or income was in debt, and that's not really a big problem because the debt might be a 25-year mortgage and whatever, you didn't have to pay it all back overnight. So the fact that it just kind of gives you a bit of a calibration. Over the period between 1990 and roughly 10 years later, 2002 in this case, household debt levels had risen up to about 120%. So they'd gone from 50% roughly to about 120. So they more than doubled. And the RBA looked at that and they scratched their heads and they got out their economic textbooks that they'd sort of, all the guys down there sort of studied out at ANU before they went to work for the RBA. And they said, "Oh, this is not a good thing. If you have household debt levels getting too high, it tends to be associated with the economy collapsing." And they made some observations back in 2003 and they said, well, if the household debt level gets up to around 130%, the economy will fail. So we better watch something about that. That was in 2002. The household debt levels got up to about 155%, something like that, at the beginning of the GFC, back in 2007, 2008. And sure enough, the RBA was right, the economy fell over. The RBA back in 2002, 2003 was looking at examples in Japan and Germany where household debt levels of around 140, 150% had caused a collapse of the economy. Now, because people were willing to borrow simply on the received wisdom that the more you borrow, the more you made, that kept the housing bubble or the housing prices moving forwards because people were getting more and more into debt. In 1990, you had two incomes in a family, but you had relatively low debt levels. By the time you get to 2000, certainly 2005, 2006, you had double incomes and you had very high levels of debt. Now for you guys, probably most of you, you just sort of think this is what household prices are like, this is what I have to borrow. For old blokes like me, I look at what you're going to be sort of facing in terms of a loan. Oh my goodness, how can you support that? But you will. And I'll grow rich when I sell my property to you when I retire and go into a retirement village or something. Okay? Because I don't mind property values going up because I'm selling, I'm not buying. Okay, so we had female labour force participation going through the roof. In 70 to 90, we had 90 to 2000, 2005, 2008. The debt levels kind of going through the roof, and so we had all of that happening. I think we might, there's one more I'd like to show you. Here we go. This brings this graph up, and we'll just finish here for today's effort. This is the basically one of the other debt ratios. It's looking at what happened as we went into the GFC. And so you can see that we went up to, what's the number there? About 160% or a little bit less than that. And we've been kind of wobbling around that level ever since. What I would suggest is, and this is where we'll finish, that we've gone from one stable situation around, let's say, 5-10% outside of 40, which was fairly constant, fairly stable, And I don't know how far back I could go there as an data. I suspect it was probably around that 30-40% back through most of the 20th century. It's kind of coming along. You get to this shoulder point, about 1990 roughly, and then we end up with a new direction going on. I think a society can only support debt levels of that 150, 160% level. In fact, I even suspect that's probably too high. I think socially we're going to sort of come unstuck when we start finding that our population is going to start shrinking. But at present, that's the new stable level. If that is the new stable level, it means that whatever incentive was squirted into the economy as a result of the addiction or the fascination that we've had with debt, over the period this side of 1990, then I would say that we can't borrow anymore. There's no more upside potential. We probably can't put any more incomes per household into the workforce to go and give us that extra upside. We can't borrow anymore, I don't think, because we're already up to our eyeballs in debt. Okay. That sort of takes the story up to about 2010, something like that. Hopefully, we'll just leave it here. Next week we'll come back and we'll sort of say a little bit more about this. But I would like you to give some thought to that and where the next source of resources is for property prices to continue to go forward. Because I think up until probably 5-10 years ago, there are these explanations that explain it. However, I think those explanations have a limited life expectancy. There's only so much upside, right? We can't do any more incomes, we can't do any more debt. So what's going to support property moving forward into the future, which is going to be an extraordinarily important question for your professional lives.